Hi, I'm Alex, welcome to the channel and thanks for tuning in. In today's video, I want to talk about Workhorse, the latest company riding the trend in the zero-emission transportation sector. In this video, we're going to look at everything you need to know about Workhorse before making an investment into them, including this big $6 billion contract they're trying to win. And in that, I'm going to look at a couple of things I haven't seen anyone else talk about yet on this topic, so you don't want to miss that. So this video will follow the same structure I did for my Hyliion video. If you haven't seen that, a link is in the description below. But first, we're going to look at what they do. Secondly, we're going to look at everything you need to know about the company. And finally, I'll touch on what my decision is. I'm not a financial advisor and this video is for entertainment and educational purposes only. Never make an investment decision purely based on the advice that you've heard on YouTube or elsewhere on the internet for that matter. Always do your own research. I'm a professional investor, it's my full-time job and have over 10 years investing experience. And I always use this experience when analysing companies such as Workhorse in this example. But let's get straight into it. What does Workhorse do? Well, primarily, Workhorse is a manufacturer of electric delivery trucks, class 3 to 6 last mile delivery trucks. The company also has activities in software and drone delivery, which we'll touch on in a second, but they were founded in 2007 and are headquartered in Ohio in the US. To date, they've built and delivered just under 400 trucks, but when thinking about this versus some of the other competitors, they have at least got a working product in the market, even if that is quite small. So the main product is the C-Series van. This is a 100-mile range electric vehicle that was designed in partnership with UPS, and in early 2018, they received an order for 1,000 of these vehicles from UPS. Workhorse's software proposition is focused around energy and route optimization for its customers. Now the data it's generating here is really powerful, and I can see a clear benefit from this software. They also have their division, Horsefly UAV. This is an FAA-approved drone delivery service. Again, very early stage, but the proposition here is the ability to deliver parcels for 4% of the cost per mile versus your fossil fuel alternatives. Now, whilst the core of the business is in electric trucks, the software and drone delivery businesses are obviously very exciting. However, you can't place too much emphasis on these when considering the valuation of the business. They're both at such a small stage, they're not commercially viable, and the market could be disrupted by any number of new entrants. There's no guarantee that these ever will reach a commercially viable scale. So don't place too much emphasis on that when making your investment decision. Currently, Workhorse's market capitalization is around $700 million, but valuation on this one's really important, and we're going to touch on that in more detail in a minute. So as investors, what do we need to know about Workhorse? Well, firstly, they're targeting a huge addressable market with product that has a clear economic value for its customers. 350,000 last mile delivery trucks are sold in the US every single year. That equates to a market value of around $18 billion. The one thing, however, we don't know is what percentage of that addressable market can be addressed by electric vehicles. And what I mean by that is, in what parts of the country does the infrastructure exist where a vehicle with a range of 100 miles can efficiently and effectively replace a fossil fuel alternative? Whilst that's not clear, what's evident is there definitely is a shift towards greener, environmentally friendlier modes of transport, and it's really high on the agenda for companies. Workhorse's product is also proven in this market. Whilst they've only delivered less than 400 vehicles, what can be proven is there's a 3-year payback for its customers on an investment into one of their trucks. Next, I think it's important to note that Workhorse has actually made some very sensible partnerships. They signed a partnership with Duke Energy in early 2019, which basically provides Workhorse's customers with the ability to finance some of the infrastructure which goes behind having these vehicles with Duke Energy. Now let me put that into a live example for you. When a delivery company shifts to an electric fleet, a whole investment needs to go into the infrastructure that supports that. Charging stations, maintenance, all those things. And so this partnership with Duke Energy enables that to be financed and spread over a longer period of time. So personally, I think that one's quite sensible. Another interesting partnership they recently made is with Lordstown Motor Company, which they entered into in November 2019. I've seen a lot of conflicting information about this online, so I took it upon myself to dig really deep into it and understand it all. And here's what it is. They ultimately signed an intellectual property licensing agreement with Lordstown Motor Company. Now, Lordstown Motor Company, LMC for short, was founded by Steve Burns, the former CEO of Workhorse. For the partnership, Workhorse received a 10% ownership stake in LMC that is non-dilutable for 2 years. What that means, if LMC issues more shares, Workhorse will not have to invest any money into LMC in order to ensure that their stake remains at 10%. They also receive a 1% license fee on gross sales for the first 200,000 trucks sold by LMC. Now, given there's no indication of how long it may take LMC to sell 200,000 trucks, if ever, this can be prepaid by LMC if they raise any more money, whether that be through raising debt or issuing new shares and raising equity. What this means is up to 1% of that money raised can be used to prepay what the equivalent would be of that 1% of gross sales in 200,000 LMC vehicles. If they never sell 200,000 vehicles but they raise sufficient capital, Workhorse would get the money. However, whilst I don't doubt that LMC will need to raise more money to execute their plan, the question is whether they'll be able to get that funding. Will there be debt market appetite to fund this business and provide loans? Or alternatively, would there be investor appetite to acquire equity in the business? That's to be seen. That being said, It's not an unlimited upside here. I've seen it being misreported a lot that this 1% of the equity raise is an unlimited cap. That's not true. The final part of the deal involves 6,000 units, which Workhorse had agreed to produce for LMC, but instead LMC will now manufacture and will pay a 4% license fee for that. Next up is the track record. Now, Workhorse was established in 2007. It's not blown up overnight, and it has a good base of recognised customers. Historically, the share price has jumped around a lot. However, recently this is particularly due to speculation. There's been no change in the business's performance to justify this increase in share price. And all the speculations around this potential $6 billion contract, which we will touch on in a second. The one final thing to remember is that Workhorse has no track record in mass production of these vehicles. So there's certainly a question mark there for me. Next up, we're going to quickly look at the financials. Firstly, cash flows. During 2019, Workhorse raised quite a lot of new money. $35 million in January, $25 million further in June, and in December, it raised a further $41 million in debt. Now, I looked into this a little more to try and understand what the debt was being used for. Firstly, to repay old debt, which actually could be really sensible financial management. If it's at a better interest rate, if there's better repayment terms, that makes a lot of sense. Secondly, it was being used to fund working capital. Now, whilst this could just be a function of the business growing and the working capital requiring funding during that period, it could also be hiding something underlying that we need to think about. Are we not able to get cash from our customers in a period of time that works for us? Or alternatively, are we being forced to pay our suppliers much more quickly than we can sustain? Secondly, we should look at the balance sheet, and especially the line item in relation to the LMC investment. For me, this is actually slightly misleading. We don't understand the basis of this valuation. However, what we do know, it's an extremely illiquid position. It can't be sold overnight for that amount. And given we know they have a 10% stake in the business, what this implies is that LMC has a value of around 130 million, which for a company founded last year with only high-level designs for a product seems quite high value. Next, we come on to the valuation, and this is the final one before we touch on the biggie, being the USPS RFP. Now, it's so important to think about valuation relative to peers, relative to the competitors doing the same thing. And yes, when a company has no revenues or very little revenues, sometimes these multiples can be misleading. However, we can certainly look at it on a forward basis. Let's do a quick little bit of maths. Assume in 2021, they sell 800 vehicles, an increase of 100% on what they'll sell during 2020. Assume each of these vehicles is sold for $50,000. In reality, there's probably a discount offered to this, but let's stick with this figure given it's what they said in their investor presentation. This would ultimately mean sales of $40 million. And on an enterprise values to sales basis, EV sales, we'll look at a multiple of around 19 times for 21. Let's assume for 2022, the number of vehicles doubles again, sold for the same price. That gives us an EV sales multiple of around 9.12 based on the current valuation. Now, if we compare this to Tesla, which on a 2021 basis is trading at between 5 and 6 times EV sales, we see that Workhorse already commands a big premium in valuation. Is that justified? Now we touch on the $6.3 billion US Postal Service RFP. As part of the US Postal Service's fleet renewal program, last year they launched an RFP for manufacturers to come to them with a proposal for 165,000 new vehicles worth roughly $6.3 billion. Now, a decision on which party to go with is expected this summer. Those vehicles would have to be delivered over a period of between 5 and 7 years, meaning roughly between 20 and 30,000 vehicles per year, which Workhorse could deliver on based on their stated factory capacity. However, as a reminder, for this year, they're only going to produce 400. And historically, before this year, they'd only ever produced less than 400 in the entire time they'd been a company. Currently, in the RFP, we know there are 4 names left: Mahindra Automotive, Carson and Morgan & Olson, Oshkosh and Ford, and Workhorse. Now, Workhorse is clearly up against a number of globally recognised automotive businesses with great track records of mass production. So can they really win this RFP and this contract? Ultimately, USPS cannot afford to get this decision wrong. The aging fleet needs to be replaced with something that works, that can be delivered on time, and that is efficient and effective. If this doesn't work out, not only would high-profile heads roll at USPS, questions may also be raised about the business's ability to operate as normal altogether. The expectation that Workhorse could win this RFP is clearly reflected in the share price. I think realistically, you need to take a step back and look at this. They're competing against globally recognised names that have mass-produced products that work. There's much more risk going with Workhorse, who will have to go through the teething pains of scaling up to manufacturing at that level. And so those are big question marks. But ultimately, nobody knows, and this is so important to the overall story. With that being said, we should note that one of Workhorse's rivals, Rivian, won the contract for Amazon's electric fleet. So look, it could be possible. So what am I doing about this opportunity? Well, again, similar to Hyliion, for me in this situation, there's just too much risk involved. There's too much speculation driving up share prices, rather than that increase in share price being driven by the fundamental performance of the business. This is the same for Nikola, the same for Hyliion. When a share price increases like this, and there's no justification from the performance of the business, that does scare me a little bit. When you spend time reading online about the business, it's quite clear that a number of speculators really do believe that they're going to win this USPS contract. If they do, great. And if they don't, that's when the bad news sets in and the share price will fall back significantly. So whilst some people may make money speculating on this opportunity, For me, there's too much risk and there's too much potential downside here. So yes, while some people may make amazing returns speculating on this stock, that's not a strategy personally I can get behind. And as is always the case in those situations, more people than not end up getting really burnt. So be careful. So thank you so much for watching. If you enjoyed this video, if you found it interesting, please like the video. It's massively helpful in getting the algorithm to push it out to a new audience so more people can learn about Workhorse and investing in general. If you like investing related content, please subscribe to the channel. It's massively appreciated. And as always, let me know your thoughts in the comment section below. Are you invested in Workhorse? What are your thoughts? What are your views? I love getting involved in that discussion. It's so interesting to hear what everyone has to say. So thank you so much for watching, and I'll see you in another video.